All right, and welcome back to another episode of the SeedLever Interview Series, where we explore some of the tips and tricks behind some of the fastest growing software companies in the world. Today, I'm very happy to introduce Nathan and Darko from True Altitude. True Altitude's mission is to provide fast growing companies with versatile capital, which helps them maximize shareholder value and minimize dilution. All things we're going to get into today, but welcome, gentlemen.
Hi, Bryce. How's it going?
Really good. Guys, I think a good place to sort of start on this is maybe if you could just give me a bit of your background, so how you ended up at True Altitude. Nathan, I don't know if you want to go first.
Yeah, definitely. So Darko and I have known each other for many years. We came from a background with a tech company. Originally, we were a company called Tamando, which was started out of Australia and was focused in e-commerce logistics. And we sort of spent a lot of time sort of building that business, and then that business exited. First half exit in 2015, and then a full exit in 2017, and that brought us to starting True Altitude. We've both got varied backgrounds. Mine's very logistics and e-commerce focused, and Darko will sort of take you through his. But what we did have was a mutual passion for startups and helping early stage businesses grow and investing, and that sort of led us to True Altitude. And I'll let Darko sort of tell you a bit about that.
Awesome. Thanks, mate. 15 years in software sales, and certainly quite an active angel investor. Early on, I made a mistake of concentrating far too much capital in too few businesses. Two ended up exiting, one ended up failing, and followed Carl and Nathan on that Tamando journey that he mentioned, and then in started 2019. Nathan and I decided that we quite like to work together, co-invest. So we pulled some funds, and we learned from past mistakes and decided to diversify. So we invested in 20 plus companies, following the sort of enterprise software, e-com spades and shovels, or enterprise software intended for the e-com vertical, and then more recently fintech. 2019, with a hope and a prayer, very little planning, admittedly. We ended up having the perfect thesis for COVID, and not to speak about that with gratitude, but COVID was a positive thing for our business because the thesis was very much cemented, and we ended up growing through COVID quite significantly, which was a fantastic outcome. And then during 2021, we consolidated that with some better planning. We expanded our offering, we expanded our team, we developed shared services, so operations, marketing, legal and finance in particular, which was handy because those are things that every functioning business should be insourcing. Leading into 2022, we're completing we have now completed our first acquisition, and have our first official fundraisers underway. So our own funds under management, which is a brilliant place to be. So going from 3 people, hope and a prayer, to 22 full-time staff and 4 contractors in a space of 3 years has been quite taxing, blistering, and wonderful at the same time.
Oh, that's fantastic! Such a journey, and I think I've been sort of blown away watching you guys as well, seeing more and more people kind of joining, and seeing some of the investments that you've been making. But I suppose for a lot of people, like, they might be kind of outside the space, not necessarily know what is a VC firm, or what private equity is, or or any of these sorts of terms. But without kind of getting you to lay it out too much, I don't know if you can maybe unpack like what your sort of investment strategy is, or your thesis is around some of this stuff, and maybe how you support the businesses that you invest in kind of on a day-to-day basis.
Yeah, definitely. Just looking at it, there are different levels, obviously, people invest at, and I guess they fall under different categories, and people could, whether it's a venture capital, whether it's private equity, they take on different forms based on how the people want to react to that. Very early on, we were very focused on sort of early stage businesses and looking at seed. So in that respect, we were taking on a lot of risk up front, and so that's a lot of capital. It's a lot cheaper to get to the ticket, but there's a lot higher chance that it's not going to be successful.
Yep.
You know, and just looking at the numbers. I guess the shift in focus, and certainly as Darko just mentioned there, we've sort of tried to get in front of the money a lot more. So shifting to being more of a venture capital firm means that you're looking at bigger tickets, you're looking at later stage businesses. There's a lot more due diligence on that money. You know, and you're also not looking at, it's not coming out of our pockets as much now. We're looking at, you know, bringing in funds from people who want to invest and who wish to sort of put money into businesses, but may not know enough about those businesses to be able to invest themselves. So what they want to do is get people in who do understand that and who do want to look at that.
Yeah, I guess just to extend on that comment, I'd say, you know, day one, we picked off those 3 verticals because we believed that was a sound thesis. It was close within our remit. It was close within our contact base. We understood it. We had a background in B2B enterprise software or e-commerce. Fintech was certainly more of a recent undertaking. But I guess if you go back to 2019, fundamental, I guess tick box was, do we like the founders? Do we think that they're going to win? So more of a follow your nose type of approach, always skin in the game whenever we pulled syndicates together from a sort of corporate finance perspective. However, that isn't scalable. And, you know, we fully recognize that. We did certainly pick some winners, but as a general concept, you do need to become a lot more discerning as a funnel. And I guess probably whilst those 3 verticals are still the mainstay of the business and the areas that we're targeting, because we believe in the future of those verticals from a tech perspective. By and large, the thesis is broadened to B2B tech-enabled businesses, north of 1.5 million revenue, have a good sound understanding of their product level gross profitability. So we seek businesses 75%. North of 75% at gross profit at a product level, and some level of complexity or requirements for complexity in their capital stack. So they do understand the concept of being able to raise debt side by side with equity. We really like those types of businesses. Seed through Series B.
Okay. Yep. That makes a lot of sense. And I think, you know, this is kind of like leading us on to, you know, a conversation around you know, preparing founders for this stuff, because, you know, certainly a lot of the founders that I'm sort of speaking to, particularly between that seed and Series A thing, you know, there's always some conversation around financing and how are we going to do it, and it is quite an undertaking. And I think it's just super interesting to get your perspective on, you know, what you see working and, you know, some of the challenges that you see, and we'll kind of unpack all of that. But maybe, you know, without giving too much of the secret sauce away. You know, I'm not sure if you can speak to, with the sort of investments you've made or the businesses that you've seen that come to you that you think have prepared well, or you think, you know, are really good outside of these core metrics. Is there any sort of similarities between them, or even any similarities between all of the sort of unprepared ones, or the ones that you wouldn't put funding behind?
Well, what are you doing good, Nathan, and I'll do the bad.
Okay, they're the good. So no, definitely the ones that are good are the ones where the founders are open to listening. I think what is very clear, even if someone's raised money previously in a previous business, is that every business is unique. And you might have been very successful in business A, but when you go to business B, there's different investors, different types, and different focus on what you're doing. For someone who's never raised money before, they don't appreciate the amount of work involved. So, you know, someone who can really dig in, and, you know, they're going to be doing a lot of phone calls, they're going to be spending a lot of time, and they've got to appreciate that they're not in the business as much, you know. So someone is a founder who understands that and who can balance their time, you know, because there is a massive time commitment to raising money. It's, you know, we've seen great businesses with great concepts and very fundable, and they just can't get out of the blocks because they can't get that first couple of rounds of funding, you know. And oftentimes once they get through that, they're fine, because once they get into the VC land, you know, VC understands their business, they've got good metrics, especially SaaS businesses. But to put money into an early stage SaaS business with no traction, most people won't do that. You know, so you're looking at angels, you're looking at really encouraging people within your close network. And I think the really good founders are very good at motivating and evangelizing to the people around them who have money and who support them very closely. And the bad.
And the bad.
and the bad. Yeah, we've got a bit of good cop, bad cop going on in our business partnership, and it works really well. It depends on the stage of the business, but I'll just talk generally late seed through Series A businesses. By the time you hit Series B, you know, metrics are well established. Businesses tend to have a fairly good grasp of their finances. So I'll just talk about slightly earlier stage companies. Every founder thinks their business is the best. We think True Altitude is the best corporate finance business on the planet. However, you know, there is a broader reality, and you have to be objective about your strengths and your weaknesses. I think a lot of founders buy their own Kool-Aid, and they have to. And occasionally, you know, constructive criticism isn't met well. And when that is the case, certainly in my case, I'm a big no when someone sort of spits good advice back in your face straight away without actually listening through it. So I think you have to buy your own Kool-Aid to succeed, but equally you should be listening to good, bad, or even mediocre advice from others, because you know there's always nuggets of gold buried within that. When founders don't have any skin in the game, we've had a couple of examples where, you know, someone's referencing very deep, defensible intellectual property, and when you actually look at it, it's an exec summary on a piece of paper, and they're saying to you, well, you know, why don't you underwrite the entire risk of it, and I'll give you 10%. You're like, well, hang on a second, like there needs to be a bit more substance and depth under it. And I think founders with skin in the game definitely carries a lot of weight, not least when we're backing our businesses, putting our own money in, and then raising on the back of our own investments with others. Skin in the game is a big winner, certainly from a corporate finance perspective as well as from a founder's perspective. Occasionally get fixated on specific perceptions of the way that things need to be done, have to be done, not pivoting quickly enough. So not being, I guess, malleable in terms of approach or changes in the business, or creating change in the business, or changing people in the business. And more so on deep tech, IP heavy. You know, we've run a couple of accelerators now. We certainly see this with kind of patentable, designable, engineering heavy type of companies. You know, the sort of broader B2B tech enabled thesis. They tend to be too technical. So the proposals and the summaries tend to be very wordy, very lengthy, very technical. And by and large, you know, any business can be described in 9 to 10 slides and no more. And there's some key things that people should look for. But when you receive, you know, a 60-page deck describing every patent in X amount of detail, it's sort of a bit much, and you know, no one's ever going to read it to that amount of detail. So I'd say occasionally suffering from too much technical substance is probably a big no-no. And then the other one is not highlighting the team. So fixating too much on the product and not putting the people to the fore, because in the early stages of the business, ultimately ideas are great, whether defensible or not, but the people matter far more. That'd be my couple of takes.
Yeah, I think I've seen a lot of this, and I think particularly, and yeah, I'm not sure if there's a difference of archetypes of founders that you see, but I see particularly people who are really invested in the product. You know, they're really kind of, you know, obsessed about the product, and you have to be that in order to, you know, make the best product kind of in your niche. But I imagine with those types of people, it's a bit harder to kind of lift your head and think maybe a bit more commercially about it. And maybe potentially that's why they're trying to, you know, stand behind the IP or stand behind these big claims. I mean, yeah, there's something that I think is, you know, it's become a bit of a meme, but you know, the whole like we don't sign NDAs type thing in VC. I imagine there's like part of that as well, of like just falling in love with the idea and then wanting for others to fall in love with it as well.
Yeah, look, you bring a solid point in the NDA. Like, you're going for money. If I'm going to put money in, and because someone signs a piece of paper, your whole idea is gone, it's not a great idea. You know, you've got to have a better business than someone can pull apart in 2 minutes. Like, you know, there's not a solid tech business on the planet that someone sees it, but if they're going to start from day one, now, if they can catch you before my money is of use, then I'm not putting my money in, you know, as simple as that. So NDAs are good if it's IP related, you know, to not take away IP. But in terms of fundraising and all that, you shouldn't be giving away that much IP. You know, you should be able to, as Darko says, explain it in one slide what this does, enough for me to want to do it without giving that all away. And founders do get caught up in that. And sometimes, you know, just because you have a great idea and you want to start a business doesn't always mean you're a good founder, you know. So you've got to have a good team around you. You've got to have people that know how to get this product to market. And you might be a builder, you know, so you're a CTO type person, excellent, but you're going to need someone to be able to convey the narrative of your business, because it just comes down to narrative in the end.
Darko, you had a really good point actually, which I hadn't thought as much about, around not highlighting the team as much. So not sort of demonstrating, like, you know, who's on the bench. And do you have any methodology or anything that you use to assess the quality of the team? I'm not sure if it's experience or you meet them, or how does that kind of work?
I think if someone could, well, actually, funnily enough, we did invest in a business that does productize people assessment, but putting that into a VC funnel, you know, right now, or corporate finance or VC funnel from our perspective is not something we've been able to productize. It still is very much, you know, sitting down with the team and the advisors and the other investors, and just understanding what they're all about culturally. Because ultimately, you have to, you know, private businesses, when it comes to cap tables, whilst they're not fixed and they can change over time and with relative flexibility, private markets and secondaries and private markets and clearing things out are quite difficult until exit. So you want to make sure that the people you're jumping in bed with, you know, you really, really like. And there's no better way than actually just spending time with them. There's no other wisdom there than simply spending time with them and understanding them as people.
Yeah, for sure. I mean, some of the things I see in this area are, I mean, you know, either solo founders or, you know, maybe two people. And, you know, maybe we could get onto whether you have opinions about the right sides of the founding team, but you know, it is one of those things where it can be a very lonely journey, sort of being a founder, and, you know, you want people to bring people on board to support you, but I suppose that's in some ways kind of the trade-off. You know, if you're giving equity or giving people sort of director seats, or they're sitting somewhere on that cap table, it's a fine balance, isn't it?
It is, and sort of learn from experience. I think the culture of a company is set by the founders, and certainly set by the CEO. Culture is huge, you know, and everyone has got their opinion on what is good and bad culture. You know, I'm sure, you know, there's businesses where it comes out that they got bad culture from an external viewpoint. They thought it was the best business ever and it's growing and everyone wants to work there. So you can't always know, but probably the biggest cultural tip in an early stage business, and it's something you got to think about when you're about to put in money into a business, is the moment that the CEO and the founders stop hiring people. So when they hire someone to hire someone, that's normally a tipping point in a business, because everyone at the start is hired by one person. Therefore, you know, you've always got someone that, you know, they think that they'll get along with, or they think is perfect for the business. The moment that changes and someone else's opinion is doing that, that can be an impact on a business. And we went through that, you know, early stages with our first, you know, our first business exited. And you get to a point when people are coming into the business with different values, you know, and it's not whether they're better or worse, it's just different, you know, and that can have an impact and start to tip a business. So certainly, normally when that happens is when money comes in. So the investment process there, as Darko said, sitting down with, you know, the founders, understanding what they're about to do and how they're going to do it. You know, ramping up an extra 100 people into a business sounds awesome, except that it can have a massive impact on how that business performs in the next 6 to 12 months.
Yeah, and at early stages, form and attitude over function. So just filling in boxes like a larger business would, whilst that works as a business is scaling. And of course you need, you know, key functions with experienced people. But I mean, and I've you know, we've done this certainly as well. We've made our first couple of functional hires and it was a bit of a revelation where you kind of fitting things into a box. But I'd hire someone on the basis of enthusiasm over mass amounts of experience any day, just because if they're getting out of bed and firing up, particularly if it's something that that hasn't been done before, which in a lot of cases, you know, with early stage companies is the case. It's like they're not trotting a well-trodden path. So, you know, rather than an entitled former corporate person that's expecting, you know, very, very specific things and will only work between certain hours of the day, you know, not encouraging bleeding employees dry, far from it. But what I'm saying is you'd hire an enthusiastic person that doesn't fully know the subject matter over someone that, you know, fits a box in an early stage company any day of the week.
Yeah, so that sweat equity thing, is it? Like, yeah, people who can, you know, really sort of like put in and kind of figure these things out.
Yep.
Yeah, absolutely. So I wanted to maybe go into the tactics a little bit, but there was something that you said there. Maybe I want to ask you one final question on this was, you know, obviously you're assessing the team, you're assessing the founders, and then there's the idea. I'm sure you spend a lot of your time sort of doing due diligence on the market and basically whether you think it's a good idea and, you know, whether you think they can, you know, have commercial success. Are there any sort of rules of thumb that you use around that? I mean, I know, you know, probably broad strokes, you know, total addressable market and all these other things, but I don't know if there's something like for you guys that are a bit closer to it, if you could unpack it a little bit.
Yeah, I think it's a difficult point because, you know, a lot of the addressable market information that's out there has come from, you know, sources of businesses already in that market. So, you know, and as we know that it's not always 100% accurate, you know, it's so we've tended to always look at areas where we kind of knew, you know, and I think we're going into new areas, you know, we're just with the recent acquisition, you know, we're finding customers in areas that we've never dealt before. So suddenly we've got to learn very quickly, you know, and the key is total addressable market normally comes from people who already understand it. So you've got to go to people in and around that area who have been there, who understand that, you know, this metric might look really rosy, but in reality, it's a sinkhole, you know, and people are plunging money into an area that's going to, you know, collapse. You know, all these are things you got to think about when you're putting capital in. So, yeah, I think there's a lot of good sources of info out there, and once you start to understand that and unpack it, I think you can make educated decisions. But it's going to come down to most startups are looking to revolutionize or evolve an industry. So a lot of the old metrics don't work anymore. So you've just got to understand that.
There's the acronyms, you know, the TAM, CAC, etc., that really matter at later stages. You know, when you start hitting Series B onwards. I think certainly in the earlier stages of funding, and where, you know, historically we've been much more focused, sort of late seed through Series A. There's other things that matter more. So I think things like having an understanding of the capital journey, so capital planning, so knowing planned dilution over the next 2 or 3 rounds. And there's nothing prescriptive. You know, things are going to change, they're going to move, they're going to have to pivot, they'll burn more, they'll burn less, etc. The point is they've given it due thought around planned dilution. They can communicate that with the shareholders. I think that's really important. One of my sort of brown M&M questions has always been, you know, brown M&M's a reference to something else, but the point is it's the lowest common denominator. So does an early stage business understand their product level gross profitability? Yeah, okay. Negative unit economics, exactly. Do you understand per license sale, per unit of sale, what your cost is, your COGS, and your gross profit, all in at a unit product level? Do you understand that? And usually, you know, if they've done adequate planning, etc., they do have the answer to that question. But if they can't answer it or they don't understand that, that's always been a big no-no for me. And then in terms of the bigger, more strategic stuff, heading out for funding, you know, having a good capital plan, also understanding the gaps that they're trying to fill. So that's really important. Having the ability to, again, back to the whole hubris issue, having an understanding of within their business where the gaps exist, and great, we're going to raise 5 million just to turbocharge sales and marketing. Okay, well that might be a gap, but have you considered channel sales, for example? Just understanding why they're raising the money from a very honest inward-looking perspective, particularly when it comes to people. So understanding where the gaps are. Those would be my big ones beyond the usual acronyms that people inquire about.
Yeah, and I think this is actually, where I can see you guys adding so much value, because it's, I imagine these conversations are very illuminating for, not even just first-time founders, but people coming, looking for finance. Like, you're going to essentially pull a lot of different parts of their business apart and really, ask the hard questions. I think it's, I can sort of see how, being able to sort of take on board maybe some of those more probing questions and even, go back to them and kind of reflect on them is probably going to be a bit of a hallmark of success rather than just kind of brushing it away.
Yeah, definitely. And I think, as Darko has mentioned there, the planned dilution, there's always going to be times in businesses where things are a bit slower or a bit faster than expected. Getting a lot of business through the door sounds great at times, but if you're a type of business that is manufacturing product, that can have its own problems. And as we've just seen the last 2 years, if you're manufacturing and all of the shipping lines are down, planes are down, nothing's happening, suddenly, getting a lot of sales through the door wasn't necessarily, a positive for those companies, because suddenly they had a massive crunch. And going out raising money to buy product or to fix those supply chain problems, which was what a lot of companies did. A lot of VCs took advantage of that. It was huge investments into businesses. Valuations might have been higher, but a lot of people diluted because they were struggling, but they got huge cash influxes. And now I guess they'll have a hangover in the next 2 years when they look back and go, wait a second, we just, we gave away a lot of our business just to fix these problems. And now we're soaring again, but we don't own most of our business, type of scenario. So these things need to be considered. And when you're going to raise more money than you thought, it's all good hearing about people raising money, but, there's a lot of businesses that never raised money and been highly successful. So, it really comes down to the planning side of things.
Okay, so I think one of the areas that I was keen to touch on that I don't think gets talked about a lot is kind of this idea of compliance, due diligence, making sure we have all these sort of structures in place. It's not the type of thing that I imagine a lot of people set out on, when they're building their first business and thinking, oh, I can't wait to have really good accounts, or can't wait to have airtight contracts around all these things. They're just thinking about building the product. But I imagine it's the type of stuff that really impacts valuations and stuff that I know you guys do a lot with. Is there sort of some key areas that you see people falling down here or really struggling around that you might be able to unpack?
I love this stuff. Shall I kick off?
Yeah, I'll let you take that one. It's definitely a Darko question.
I'm a masochist, Bryce. I love this stuff. I think the fundamental, like, overarching thing that the founders misunderstand or I guess need to delve in deeper when seeking investment, choosing who they take on as investors or bring into the business more generally, is this concept of value versus control. So not getting hung up about just the bright shiny pound or dollar signs in front of what someone's willing to give them within their business, but also what up or downside that carries in terms of their own control or the ability to influence within the business. I think that's where it all ultimately stems from. There's, I guess, a few basic things, even in advance of taking investment on, in terms of what an investor or corporate finance house like ours would look for from a compliance perspective. It's having absolute clarity around the cap table. So who owns what, under what share structures. Whilst you'd never expect like an early stage business to have full compliance controls, just some basic governance measures, like, for example, the presence of a clear shareholders agreement that matches the articles of association. Really basic stuff. So, you know, if a shareholders agreement is 30-40% detached from, you know, what the sort of local governing company's house or company's house equivalent is, that's clearly an issue, because they haven't really tidied their back office. So I guess the shareholders agreement matching up with the articles of association. When it comes to dilution, again, that's quite important. So this whole concept of ESOPs, EMIs, options pools, having them clearly documented and articulated. I mean, I've had later stage businesses that we've worked with that have made quite large, significant promises to shareholders on an options basis that are totally undocumented, that just happen to change through a given process. And that creates subsequent legal burden, which is obviously a massive issue. So back to planned dilution, have it signed off and documented. Simple measures like having a central contract repository. You know, don't run everything offline. Use DocuSign, use Adobe. If you have key documents that are being signed within the business, keep it in a single place, and that will make your life easier longer term. And then yeah, something happened recently where, you know, business didn't have a shareholders agreement, and that entrusted a third-party accountancy firm to register 2 tiers of shareholdings under the company articles. And the founder, to this day, still can't explain to me what the split in voting rights actually looks like. 50-50 ownership in that founder's favor in terms of the split voting rights, but there's still nothing in the company constitution that clearly articulates why they even split the shares to begin with. So just, you know, just those sort of things, and they do matter. They really, really do matter. It's like possibly the most boring corner of business, but ultimately, you know, until these things are tidied up, investment's very, very hard to come by. So that'd just be my quick summary.
Yeah. And I'd probably just another area that I'd just add there is obviously when founders are going to raise funding, you know, when you start dealing with parties that are putting in significant amounts of money, you've got to be careful, because often they, you know, you send out, this is what my business is about, this is what I want you to invest into. They'll often come back with a sheet saying, well, this is how we invest. And the amount of times that we've read those, and it's sort of like, we will control every decision you make, every hire. If you spend more than five pounds, you know, we're going to make a decision on that. We'll have board seats, but we'll have control with 1 seat. You know, all of these factors that, you know, people are trying to protect their money, and it's their job to do that. But at the same time, as a founder, you've got to make sure that, you know, it's an early stage business and people are investing into you as a founder. If they don't trust you to make those decisions, then they probably shouldn't be putting their money in. So, you know, there's got to be that give and take. And I think, you know, onerous terms at a very early stage of a business can have massive impact on that business's ability to raise money and to bring in future funders, because you can't give that same guarantee to the next tier. So you get to a Series A and people expect the same level of, you know, respect, you know, in terms of their money. You can't do it for 2 people. So what do you do then? Now you're stuck and you got to fight your way out of it. So I think just making sure that you're checking those at early stages is important.
Yeah,
I'd add one more thing we haven't talked about, which is employees. So, you know, we talked about overarching company governance, you know, treatment of investors, SHAs versus articles, but I think themployees are also really, really important, or contractors. So even at early stages, everyone that's engaged within the business, whether it's a founder, third-party contracted business, etc., or an advisor, are clearly contracted with KPIs. You know, there's very clear intellectual property provisions built into their contracts, expectations from the business to them. Again, whether they're founders or not, are also clearly articulated, because we are heading into a period where there's going to be increasing labor restrictions and regulations when it comes to how you can treat third-party contractors and versus PAYE. In the employee's favor, which is fantastic. But again, I guess the recommendation is to have very, very clearly articulated contracts, expectations, and provisions between the business and the people.
Yeah, I imagine a big part of that is IP as well, right? Like if for software businesses, like that's kind of more or less all they have to sell is like that and the infrastructure that delivers it. So if you've got past developers who might have done a bit of work for you, but it was sort of a mate or something, or or someone on a on a freelancer website, and you don't have a proper contract with them, I imagine tracking those people down 2 or 3 years in the future is a tricky one.
You need to own all of it. It's as simple as that. There's different ways to build a product, especially when we're talking about SaaS. I'm a big fan of the CTO having skin in the game. I've seen when they don't. If someone's building it, you could have the best founders ever, but the CTO in the early stage is controlling the fate of that business. If they deliver, you're in good shape, and you can always find out. If you haven't got a product, you haven't got something to sell. So, them having skin in the game, making sure that IP is locked down. Often founders own the IP, the business doesn't. So that's a big thing when you're an investor. You look at and you say, who owns this IP? And that's probably the first question we ask whenever we look at a tech business. Because if the business doesn't own it, there's no value in that business. It's where that IP sits. So yeah, these are all definitely governance and compliance issues that both sides need to look at.
I get the impression it's so easy to go wrong here. It's just a point. Like I could just say so many people I work with, I could just totally see them thinking a lot of this sort of stuff is trivial. But I don't know, maybe that's a good point to sort of get onto what some of you guys do, because I think your service offering and all the things that you guys do touches on a lot of this. And I know there's some bits in the compliance space, but maybe just to pick up on a point you mentioned before around control. I know you're selling equity in the business. That's going to lead to a loss of some control, and under what terms is obviously negotiable. But my understanding is you guys at Triage have a few different financing options that's available for businesses depending on their needs and their size. Might be interested to hear about like what those are, and maybe what some of the benefits of each sort of type might be if a founder's looking to bring some finance onto the business.
Sure. I'll do it. So at very actually early or late stages, there's a bit of a war. A bit of an arms race happening at the moment between governments. So there are some very, very good sources of government grant funding, particularly orientated towards key government policy pillars. They're all after tech talent, sort of future growth or high growth industries. So I think that's definitely something to leverage, but you do need an expert. Again, back to dealing with private investors. This is very different. This is like deep technical language, using some very specific words. And I think we've certainly had benefit of using expert third parties on behalf of our clients to source government grants. R&D tax rebates, huge around the world. Again, another category going up. So anything that is deemed to be innovative or somehow novel can be claimed back against tax, and that's hugely useful as an instrument. In the UK, it's even better than a lot of countries around the world because it's actually a cash bursary grant, much like EIS. And then you've got your mix of equity and debt, and this is where we get into the whole capital planning construction. Debt has got cheaper. How long that lasts, we'll see. But certainly, debt is being a lot cheaper and more abundantly available at earlier stages in the journey. And the founders do have benefit now of, communicating that language in terms of their growth requirements in balancing equity and debt. And whilst debt can be more onerous, because often funders act much more like a bank. It's tier one, firstly in capital. They do take the silverware first, but it's non-dilutive, and it is quite cheap. So if your business is growing at 40% clip and you can borrow at 8 to 10%, then clearly balancing that with the equity is a very useful instrument. And debt comes in a couple of forms. In our case, that we've been sourcing above our clients. Venture debt's a very useful instrument. So that's a longer term drawdown facility that a business can use an equity round as collateral. It's to come with slightly less covenants than other forms of debt. You've got asset finance. So for any physical product, we launched a new offering to support early stage companies with asset finance, which is effectively a form of factoring, where a early stage business that's producing or in need of equipment that has an underlying value, whether it's a smartphone, a wearable, a 5G pylon, an electric vehicle, whatever it may be, as long as they're B2B and their end client is solvent, it's a fantastic option for them to actually finance inventory. And the reason is most equity investors don't like financing inventory off equity. They will want equity to be used for R&D. They want equity to be used for sales and marketing, not for manufacturing or developing inventory. So I think that's probably a summary. There are a lot of emerging options with software factoring as well. We've not done any measurable deals of that scale. We certainly have some options heading into this year to develop our own factoring offering. So without the use of sort of an underlying asset, but that's future. That's not now.
I think probably the one thing that's certainly evolved in the way that we look at it, we started very early looking at putting money in, putting our own money in. So we weren't thinking about this. I think what you start to do as the companies grow is you've got to start thinking about ways to reorganize founders and management's thoughts on what's good money, what's bad money. Non-dilutive debt options are good money to have if you can support it, and if you've got the finance to do it. What's the point of, it's such a culture at the moment that people are out raising a lot of money, and putting out the headlines. But if you can avoid diluting and still get to the same spot, then that's a good thing. And it's always going to look better when that next VC comes around and realizes that you did a really good job building a profitable business without needing to just go and raise money every time. So these are all factors that people take in, and sometimes it's great. People raise a lot and they dilute heaps and they exit with huge numbers, but that's such a small percentage. It's much better to have a sustainable business.
There's so much we've covered here, and I just want to pull all of it apart, but maybe an apt way to finish this and just be respectful of your time is to talk about the exit, the kind of thing that all founders want, hopefully, whether it's 3, 5, 20, 50 years away, who knows, depending on their appetite. But is there any advice that you could give to people around how to think about that exit process? Probably we've touched on a little bit, just around some of the difficulties of it, but I don't know if there's any sort of misconceptions that people come to you guys with that you could try to dispel, or if there's any advice you had in terms of thinking about, how to finally get out of the game.
Yeah, I've got a very simple philosophy when I deal, because a lot of what I do on a day-to-day basis is deal with people who are looking at where their business is going. And one of the first questions I asked is, who do you think you'd exit to? And the amount of times people go, I don't know, well, a lot of your decisions, decisions you make on partnerships, the decisions on how you structure your business. Is it a SaaS business? Is it what's the finances, the type of people you hire, what's their background? All of these are setting a scene for someone to buy you in the future, because very few want to, exit with a gold watch in 30 years. That's not how founders think. They're thinking about, I want a 5-7 year window to sell this business. And you should know already the type of businesses. Now that'll change, but you should know who you're doing, because if you're making announcements and you're targeting towards, I don't know, a large logistics businesses, to acquire you in the future, every announcement you make has to be aligned to their thinking, because you've got to catch their eye. And, you've got to be sort of catering your thoughts and your team's thoughts, that, you know, we're going to exit this and we're growing something that's valuable to someone else. You know, it's got to be valuable to someone to buy it. So yeah, I just think that it should be like, we've been involved in the starting of businesses, and I swear it's the fourth thing that you do after you go, what's our product, what's our market, what are we doing, who do we want to exit to? You know, because that changes your mindset on the way that you go about it, and it just focuses you in, and I think that's a great thing.
100% agree with Nathan. Private companies are illiquid fundamentally, and that's a problem that can be solved. Governance ties up businesses in a knot, but I think first thing is the willingness of a founder to exit, full stop. I've worked with one particular business for a while, and the founder is continuously unwilling to entertain any form of loss of control or otherwise. And, you know, that makes for a very difficult process. It's very difficult for his employees, but you know what? He doesn't need to. So I guess willingness and understanding that is something that potentially is an option to a founder initially is obviously important to them and to their investors. But if you have a bad seller, then there's nothing under this earth that you could possibly do to prevent that. And then in terms of scale of exit, so you have a willing participant, you know, getting caught up in the sort of stargazing of unicorn status or listing on NASDAQ, even though you can do smaller listings. A trade exit is two orders of magnitude more likely to work for most early stage or earlier stage software or B2B tech-enabled companies. Those 50 to 100 million exits are 100 times more likely to happen than an IPO or a billion plus exit. So looking at sort of timescales, it's much more realistic to find an adequate trade exit with a large company that's looking to fill the capability hole than to take something all the way through to IPO. And that's really healthy discussion for a founder to be having internally with the team and with their investors and with their advisors around, you know, where is this best placed in terms of, you know, a much nearer term, smaller, less glamorous ticket, but also much more likely to be executed. So I'd encourage any, particularly B2B companies, any B2B founders to look at trade exits as a route, as a preferred road, rather than large scale IPO or sort of waiting for the big B number.
Certainly. And circling back to your first question, Bryce, around what makes a good founder. Good founders are the ones that everyone in their business will be aligned when you're ready to exit. You know, if you're not aligned and, you know, you've got people swimming in opposite directions, you know, that's a major issue. You know, the reason why you set it very early and you understand the path you're going, because if it changes, that's fine, but you're all on board. But if you get to that stage and you're not aligned, you know, that's going to end up costing a lot of money to the business, yeah, and to everyone that's invested in you along that journey.
As I feel like I want to steal another 2 hours of your time and ask you another 100 questions, but you've got you know, things to be getting on with. So I just wanted to thank you both of you so much for educating me and also for, you know, well, the founders that I'd love to show this to. But you know, you're clearly a lot better placed than I am to answer some of these questions. So I don't know if there are founders out there who are kind of going on this journey and you know, they might be in a position where they want to, you know, have some of these conversations and maybe get the Darko and Nathan treatment in terms of a few probing questions, hopefully helpful ones. Is there a best way for them to sort of engage with you guys?
Yeah, reach out to Bryce as our partner, and he can act as a filter and send us the best possible opportunities. No, we love working with founders. I think that the fundamental reason why we started the business to begin with is, you know, in contrast to working with big corporate clients or working within a big corporate, what I love about working with founders is they believe in a better future. They believe in a better future for humanity, and that, you know, that energy is always infectious and something that, you know, we love working with. So, you know, if you're a late seed through Series B founder, by all means reach out either directly on our webpage, LinkedIn, or via our partner, Mr. Davies, and he can take all the accolades and lauded acclaim.